The top business stories live from the Sky News City studio. The Bank of England, as expected, keeps interest rates on hold and warns there won't be cuts for some time. We'll ask some of the city's top investors what they make of the decision. Plus, not exactly a clean sheet. Find out the record sums of money football clubs have spent on agents and transfers fees this year alone. Good afternoon, this is Business Live with me, Ian King. We begin with the Bank of England's decision today to hold interest rates at the highest level for 15 years. The bank set itself apart from the US Federal Reserve, which last night indicated it expects to cut interest rates several times next year. The bank had raised its main policy rate in 14 consecutive meetings from December 2021 in a push to reduce inflation, bringing it to the current 5.25% in August. This is the third meeting since then, in which time bank rate has gone unchanged. Well, speaking this afternoon, the Governor of the Bank of England, Andrew Bailey, said things would have to change for cuts to be considered.
I think that the persistence of inflation remains an issue, and it's something we discuss and consider a lot in the Monetary Policy Committee. We've seen an unwinding of many of the shocks that we had, the big shocks that we had last year, particularly related to the war in Ukraine and so on. It's really too early to start speculating about cutting interest rates. We've got to see more progress. I'm encouraged by the progress we've seen. Don't get me wrong, I'm very encouraged by the progress we've seen. But it's too early to start speculating that we'll be cutting soon.
Well, while that decision was being announced, the city's top money managers were meeting at the London Stock Exchange for the Edelman Smithfield Investment Summit. The gathering allowed investors to chew over some of the big themes they expect to see next year, as well as today's interest rate decision. Well, earlier I spoke to Gurpreet Gill, macro strategist in global fixed income at Goldman Sachs Asset Management.
What's surprising is that they didn't necessarily pivot towards a stance of hinting at rate cuts like we saw from the Federal Reserve last night. So in some regards that's surprising, but in other regards it's not, because they probably need to see more confirmation in the data before they do begin to adjust their guidance.
Now, you at Goldman Sachs are considerably more dovish than the market is otherwise expecting. You have the bank cutting interest rate 5 times next year. Why?
Yeah, look, that expectation is rooted in the economic outlook. So the UK is seeing wage pressures, underlying inflation pressures fast decelerate. We are still at levels that are above target, but we are trending downwards. One of the other reasons for that is that we're seeing slowing momentum in the economy, and that is broad-based across all sectors of the economy. And it's also worth bearing in mind that the Bank of England's starting point for policy is more restrictive than its peers in the US or Euro area, and that's because the UK economy is more sensitive to higher interest rates. And so those factors taken together lead us to expect the Bank of England, who's been talking about tracking Table Mountain, so a trajectory of reaching a peak and staying there for a prolonged period of time, we think that descent from Table Mountain will start sooner than they currently are hinting at.
And yet we've had members of the MPC in the fairly recent past saying that they would be prepared to risk a recession if that was the price that would have to be paid to bring inflation down to the target level. You kind of think it's a bit more balanced than that?
I think one of the biggest defining themes of 2024 is going to be a more balanced policy outlook. So the first time in 2 years, central banks are going to be carefully balancing efforts to bring inflation closer towards target with balancing downside growth risks. So I do think that we're facing a more balanced policy outlook for the first time in 2 years.
What are your expectations in terms of UK GDP next year? Is the UK going to avoid a recession?
I think the UK, among the major economies, is most likely to experience a downturn and a steeper growth deceleration. Much depends on when the Bank of England will pivot towards easing, but I definitely think among the major economies, the growth prospects look dimmer in the UK.
Strange sort of recession, though. I mean, we have unemployment at only 4.2% here in the UK. I mean, this would be a recession unlike any that we've really previously known.
Yeah, look, indeed, one of the other defining features of this post-pandemic cycle is just how healthy labour markets are. That's in the UK, in the Euro area, but also the US. And so that could lead to a mild recession when we don't expect the short but sharp downturn that we saw in response to the pandemic shock, assuming no exogenous shock. So it may be a slowdown, a correction. Maybe that is what is needed to bring inflation closer towards target. But we definitely do expect slowing growth momentum, and we see it already in the data.
Now, further afield, obviously, as you say, very dovish statement last night from the Federal Reserve, but they're expecting 3 rate cuts next year. Well, that's what they've guided the market towards. Again, you think there will be more than that?
Yeah, I think in the US, one of the things that was interesting that Chair Powell emphasized in the press conference and in his comments was that policy is well into restrictive territory. So what he means by that is that even if you begin to engage in rate cuts, you're not necessarily moving policy from restrictive to easy, you're moving more towards a normal environment.
What about individual calls? I mean, one of the calls that you're making next year is look at emerging market corporate bonds. Why have you lighted on that in particular?
Yeah, look, that's not a new call. That's a structural view on the fact that emerging market corporate bonds offer you a very attractive yield relative to the same quality bond issued by a developed market company. And we don't think that necessarily reflects any difference in fundamentals or the credit worthiness of that issuer. We think it just simply reflects the fact that that market is under-researched and therefore under-invested. But I think if you're an active manager, there's actually lots of opportunities to find active return potential there. Like you can get exposure to recession-resistant food companies that are catering to a growing middle class, and everything to Indian renewable firms that are helping to drive the energy transition. So very opportunistic investment opportunity set.
Some other business news stories for you now. And shares of Currys have surged by more than 11% after the UK's largest electrical goods retailer reassured investors that this year's results would be in line with expectations. Currys, which makes most of its sales during the second half of its financial year, was reporting an adjusted pre-tax loss of £16 million for the 6 months to the 28th of October. That was down from one of £17 million in the same period last year. Alex Baldock, the chief executive, told Sky News that while consumers were under financial pressure in many cases, they were still spending, with air fryers and gaming consoles among lines continuing to sell well. The FTSE 100 distribution giant Bunzl said today that full-year operating profits would be slightly ahead of expectations. Bunzl, which supplies packaging materials, safety equipment and cleaning and hygiene supplies, said it was despite lower COVID-related sales and reduced benefit from inflation. The company, which employs 21,000 people around the world, said it expects sales to increase in 2024 thanks to both acquisitions and its growth in its existing businesses. The shares have risen by 2%. The outsourcing group Serco said today results will be better than expected this year, thanks partly to strong demand in the UK and in Europe for its immigration services. Serco provides housing and support for asylum seekers in the community and operating secure detention services on behalf of government immigration departments. It announced today it's buying European Home Care, a leading private provider of immigration services in Germany, for €40 million. The shares have risen by more than 5% today. FIFA has announced a record high year for the amount of money spent on football players' agents. The football body says clubs spent more than £700 million on agents this year, with English teams again spending the most by far. Our sports correspondent Rob Harris joins me now. Rob, I gather this is only transfers from overseas. This isn't domestic transfers.
Yes, so this wouldn't include, for instance, Declan Rice's £100 million plus deal to join Arsenal from West Ham, or say Mason Mount from Chelsea to Manchester United. But it shows the scale of the agent business in world football, the fact they're earning so much money, the fact what we're looking at, a 42% increase on last year alone in the fees agents are earning for deals. So what, around £700 million? And in terms of English clubs, well, they're forking out around £220 million. And what reflects perhaps the market most is you look at Saudi Arabia. Now, Saudi clubs are spending just around £70 million throughout 2023 on deals, and we've seen them sign Neymar and particularly in the last year as well, Jordan Henderson from Liverpool. Some of the big money moves there involved in to grow the Saudi league, but still the dominance of English clubs is what is reflected in this, with that £220 million spend. I mean, if you look at Chelsea, they've spent around £600 million in the last year on players, and to get those deals done requires spending on agents. And in some cases, FIFA say that agents can be earning more than $10 million from individual deals, and in 224 cases, agents earned at least $1 million. There are moves by FIFA to try to cap this agent spending. They had wanted to cap, in some cases, a maximum of 10% of the fee the agent is earned, in some cases around 3%. But those moves have come into conflict with the agents, naturally, who've challenged the rules. And just today, we've had details from the Football Association about the successful challenge by agents in England to put those curbs on agent earnings on hold. A sense from the FIFA, the FA tribunal, that they're potentially anti-competitive. So the FIFA's attempts to introduce those agent reforms in totality aren't being successful, but some changes are in place, so an agent can't represent both the buying and the selling side, according to these reforms, which is an attempt to limit the earning of agents. But for many players, they'll see agents as vital to get those deals done. And of course, not just at the top end of the Premier League, but also in the lower leagues when the search for clubs can be a struggle. And in another landmark, perhaps, for the game, agent fees in the women's game have exceeded $1 million for the first time, but it really shows the disparity in terms of where the spending is in the men's game.
All right, thanks, Rob. Back now to the investment summit that's been taking place today at the London Stock Exchange. The UK stock market has been a laggard this year compared with its international peers. The FTSE All-Share and the FTSE 100 are up by just 1% year to date, while the S&P 500 in the US is up by 24%, Japan's Nikkei 225 by 27%, and the DAX in Germany by 19%. But could the UK outshine its peers in 2024? Well, Matthew Beasley, the chief executive of Jupiter Asset Management, thinks it could, but he began by telling me the main influence on stocks will be the bond market.
Yeah, I think that's probably right. I mean, look, you're starting to see a bit of that this year already, with markets having rallied quite strongly in recent weeks, and of course, today as well, given the news from the Federal Reserve overnight. I mean, ultimately, equities are, they're an interesting asset class, but I think right now it's a reciprocal of how the bond market moves. If the bond market moves favourably, i.e. yields fall, that's good for equity valuations.
Absolutely. But I mean, you say also, apart from that, there's nothing really to sort of drive equity valuations higher.
Well, I think the concern next year is that we maybe see a little bit of lack of growth in equities globally, but especially here in the UK. Your growth is going to be at a premium. We still have issues with costs. Inflation is still present in the system. That's going to squeeze profit margins. And with valuations broadly looking quite fair in most equity markets, the only delta is going to be whether, because of lower bond yields, people value equities mechanically higher.
And yet, it's quite surprising. If you look at trading updates recently, by and large, companies have been surprising the market. I mean, we've just had a few examples today, Serco and Bunzl, for example.
Yes, so far, and I think this is the concern, is that as you roll into next year, growth is going to get tougher. We know rates are going to bite, given the lagging impact of monetary policy on the real world economy. And with rates rising still in terms of impacting company profit margins and those cost pressures manifesting themselves, it could be that profit almost hiatus, that golden Goldilocks period we've been in, comes a bit unstuck into next year. And that's why a key driver of equities is going to be what happens to bonds.
If you look at the interest rate outlook, though, I mean, clearly the Fed are signalling rate cuts next year, 3 of them at least. The Bank of England has today said probably third quarter of next year they will start to loosen monetary policy. I mean, that ought to provide a bit of a tailwind for a lot of corporates, shouldn't it?
Yeah, I think it does. And look, you started to see that reflected in equity prices already. I mean, that's the move we've seen over November and the early part of December. I think the risk is that inflation is a little bit stickier than people think. It's interesting, yesterday, we had some news out of the Federal Reserve, as you referenced, and market participants immediately discounted more rate rises than they were previously anticipating. So the market's moving faster than the Federal Reserve and perhaps other central banks are suggesting is likely. And so that means the risk is to the downside. The risk is that we don't get positively surprised, we get negatively surprised. And inflation is stickier, costs are higher, growth is under pressure because of that lagging nature of monetary policy. That could be a challenging environment, at least at the margin initially, for equity markets.
Now, one corner of the equity markets globally this year that has outperformed is Japan. And interestingly, you think the UK could be the new Japan next year?
The UK has been an unloved market for many years now. Japan has been unloved for more years than the UK has been unloved. But there's suddenly been a change in view about Japan. With monetary policy there having had a noticeable impact on underlying economy, the valuation discount has eventually become attractive to investors. And here in the UK, ultimately, as you look forward into 2024, we are going to have a more stable political environment. So the economic environment is less uncertain than it was, if you forgive the double negative. And with low valuations as a starting point, that could be attractive. And with UK equities having largely been ignored by non-UK based investors, that could lead us to see a marginal investor find UK equities attractive for the first time in perhaps 6 or 7 years.
Another point that you make, you're not the first person to say it on this programme, is that M&A activity potentially a driver next year, particularly from private equity companies.
$4.5 trillion of dry private asset powder out there in the world, of which $2.5 trillion of that is private equity money. And look at some geographies like the UK, ultimately an attractive, stable place to do business, and the amount of money that has been received by private equity but yet to be deployed. If markets like the UK stay cheap, private equity will come in and find those assets attractive and ultimately take them off the public market. And I think having had a year and a half of a lack of private market activity, private equity investors have typically sat on their hands in recent years, given the challenging geopolitical and macroeconomic environment that we've been in. If that becomes more stable, the chance of that money being infiltrated into markets like the UK, I think is quite significant.
And next year we're probably going to see a general election here in the UK. Is that going to bear on market sentiment at all?
I think largely no. I think most equity investors in the UK are relatively ambivalent towards the Conservative Party and the Labour Party. The Labour Party are increasingly a known. They've worked very hard to make sure there are going to be no surprises in terms of their initial views and approaches towards economic policy. So actually, no, I don't think it's going to be a big driver of markets in 2024.
Matthew Beasley from Jupiter there, always worth listening to. Well, still to come here on Business Live. We'll have a look at how the markets are doing this Thursday afternoon. Don't go away.
It's one of the two unusual meteor showers of the year, because most meteor showers are associated with comets, the debris that comes off icy bodies as they fly close to the sun. These are associated with an asteroid, and in this particular case, an asteroid called 3200 Phaethon. And the unusual thing about this is because these are very bright meteors when they come through the sky, very bright indeed, very yellowish in colour, and they look very different in many cases to the usual wispy type of things we get. And because it's associated with an asteroid, people have been wondering how on earth the material came off. A paper published just this year suggested that what we're looking at is a rocky comet rather than an icy comet, which had a catastrophic failure when it flew close to the sun and broke apart, forming 3 asteroids, one of which is Phaethon. And the orbit of Phaethon is really bizarre because it's a very elongated orbit, takes 500 odd days to orbit the sun and gets really close to the sun. So therefore all the ices that would have been associated with the comet have actually burned away, leaving just this rocky debris which comes off, we think caused by sodium bubbling just underneath the surface. Go out into your garden.
What time? Any time?
I would go in any time after midnight, but it's usually best between 2 and 4 a.m, weather permitting, of course. Look to the darkest
When
part.
I'm on my way to work.
Yeah, look to the darkest part of the sky. If you get away from street lights, all the better, but we have no moon to interfere, which is brilliant for us at the moment in time. And just lie back and enjoy it. Get a nice cosy chair out, get some warm clothing on, a nice warm drink, and allow 20 minutes for your eyes to adapt to the darkness. That's really important. And you should actually see the shooting stars flying over your head. You'll see a shooting star. I mean, the pictures on the captions, which you've got behind you, are quite correct. So you'll see a sudden streak of light going across the sky. And as they're really quite bright, they'll be brighter than the normal little ones you see. So you might even see some fireballs with a bit of luck.
5 of us have made it out of the car.
Welcome to Backstage, the film and TV podcast.
Fly Emirates, fly better. Fly Emirates, fly better. Thank you.
Welcome back. Time for a look at the markets now. The US dollar hit a 4-month low today against a basket of currencies after the US Federal Reserve's indication last night that interest rate cuts are coming. As you can see, sterling currently 1.25 percentage points ahead against the greenback. That is a big, big move on the day. Likewise, the euro up by more than 1% against the dollar. Sterling, meanwhile, very little changed against the single currency. In Europe, though, interesting story here with equity markets. I mean, it was a very, very solid morning. The DAX and the CAC 40 both hit all-time highs earlier today. You can see they've given back some of these gains following this lunchtime's hawkish commentary from the European Central Bank. Well, here in London, likewise, the FTSE 100 has given back some of its gains from earlier on in the session. The FTSE, however, earlier hit its highest level since the 22nd of September. It was a broad-based rally. Among the leading gainers today was Ashtead, the plant and tool hire company, big exposure there to the US housing market, while the gaming group Entain's up another 6.5% after yesterday's management changes. Outside the FTSE 100, well, the FTSE 100, mid-250, is at its highest level since the 27th of July. Leading gainers there included Currys, who, if you were watching our morning programme, you'll have seen the chief executive on there. Over on Wall Street, all of the main stock indices have opened higher after Wednesday's stellar showing. Apple has hit a new all-time high today. Meanwhile, Walt Disney is another talking point. It is ahead by just under 1.5% right now. That's after the activist investor Nelson Peltz named 2 candidates for the Entertainment and Resorts Giants board. Meanwhile, the oil price continues to claw back earlier losses in the week. Barrel of Brent crude will currently set you back $76.73 a barrel. That's up nearly 3.5% on the session. Well, with me in the studio now is George Ligarius, chief economist at Mazars Wealth Management. George, good to see you again. What a day. I mean, what a 24 hours. So the Fed goes dovish. ECB and the Bank of England, by contrast, quite hawkish. And we've got a rate rise in Norway.
Well, yeah, honestly, I would have expected the ECB to be the dovish one and the Fed to remain more vigilant. Definitely the Fed has stumbled the markets. No one saw that one coming. And, you can see this from the reaction of risk assets following the announcement. But having said that, what we saw was a dot plot and some nice words from Chairman Powell. So I'm wondering how the next month will play out, because if this was a Dove rebellion, maybe the hawks come out to moderate those expectations, because at the end of the day, what's happening is that markets now are getting, again, ahead of themselves. We're pricing in rate cuts for March, and the 10-year yield is near 4%. So that's a lot of rate cuts.
It is extraordinary. By the way, I should say, you used the term dot plot there. That is that's what the projections of the Fed's voting members project forward interest rates, isn't it?
Yes.
What are the implications of all this then for equities? I mean, as you say, huge move in 10-year Treasury yields. I mean, it's in the space of 6 weeks, it's gone from 5 to 4.
Well, so for equities, the implications are simple. If you have one central bank that is dovish, so if that's the case, entire world has changed since Wednesday, then good things for US equities and maybe not so good things for European and UK equities. In terms of bonds, pretty much similar situation for yields.
What about the movement that we've seen in sterling today? I mean, a big jump against the dollar. Is this good news for the UK in terms of it dampens import inflation, or is it bad news in terms of it hits exports?
Well, I think this is more of a dollar movement, dollar going south than the pound gaining, and it's really all about the interest rate differential. a good move upwards for the pound would be something, news that would show that the UK is gaining international acceptance.
We haven't talked much about the ECB on the programme today. I mean, again, quite surprisingly hawkish from the ECB. I mean, until recently, people have been betting on the ECB cutting interest rates before the Federal Reserve. Where do you think that debate is now?
Well, I had talked to a German partner of our company lately, and he told me that they consider the ECB to be fairly independent. So they, despite the fact that the German economy is having a Hindenburg moment, they will not be pressured into action because of low growth in Germany. So I sort of expected that. And ending of the PEP program, this is the purchases around the pandemic, the asset purchases around the pandemic. So they're sort of curtailing that, which makes sense. We don't have a pandemic anymore. So what the ECB said resonates. Inflation doesn't seem beaten. The only thing that's really out of line with the whole data that's set that we're seeing right now is probably that Fed dot plot. That's why I'd like to see more.
OK, George, got to leave it there. Good to see you in person again this week. Thank you. That's it from me. I'm back tomorrow morning with our next edition at 11:30. Hope very much you can join me for that. But do stay tuned. Coming up next after this very short ad break, it's Mark Austin with the News Hour. Thanks for joining me today. Busy day. Cheerio.